Okay, I'm going to talk about chapter 9, the net present value. We call it NPV analysis. So we're going to cover in this lecture the net present value, NPV, the payback rule, and average accounting return, AAR, and the internal rate of return, the IRR. These are the NPV and the IRR. Those are the two important analysis for making investment decisions. Net present value, okay. So when we are making investment decisions, right, we also need to rely on a decision criteria. So what would be a good decision criteria? Okay. When we are considering investment decisions, we are considering what is my initial investment. Okay, what are the future cash flows look like, right? So when you are dealing with the future cash flows, right? Do you consider the time value of money, right? Do you consider the time value of money? Do you consider risk? Okay, so for any investment, it has a risk. Right? So in that decision, did you consider risk? Does the decision rule provide information on whether we are creating value for the firm? Okay, ultimately, you want to create value for the firm, for the company. So therefore, does that decision rule provide such information? Okay, so it will be much easier if we go through one example. Okay, so in this example, we can see the cash flow structures. Initial investment, you're going to invest $31,000. Year one, you have a cash flow back 11,000. Year two, 12,100. Year three, 13,310. Okay, so that's kind of the cash flow structures. So cash outflow, that's your initial investment at the very beginning, 31,000, and then at the end of each year, you have some kind of cash flow back. Okay. If you consider the risk, okay, and then you require the return to be 10%. Okay. So now let's see how this mapped out in the net present value analysis. So net present value is the difference between the market value of a project and its cost. Okay. So the cost would be the initial investment, right? For a conventional like type of project, you have a one-time initial investment, and then you will receive future cash flows, right? So how much value is created from undertaking an investment? Those are the questions you want to ask. The value creation, right? And first, you have to estimate what are the future cash flows, okay? Before the project is undertaken, right, you don't know the real numbers. You can only make estimation. Second, you want to estimate the required return. So that's your discount rate, right? The third one is to find the present value of the cash flows, okay, and subtract the initial investment. Okay, so in this case, the decision rule would be if the net present value is a positive, okay, if the market value subtract your initial investment is positive, of course, the value increased, right? So, you want to accept the project. So back to this example, okay, we're going to calculate the NPV, right? So the cash flow has been estimated. And we know the required return is 10%, okay? So we are going to calculate the NPV for this project. So what should we do if we use the mathematical formulas, well, the first, at the end of the year one, that 11,000 has to be discounted to calculate the present value. And the discount factor is 1.1, which is 1 plus 10%. 10% is required return. So that will be the discount factor, right? So you go 11,000 divided by 1.1. And at the end of the second year, the cash flow is 12,100. So this time you're going to discount by 1.1, but by 2 years to the power of 2. And now the last one is the third year. At the end of the third year, so 13,310. So that will be discounted by 1.1 to the power of 3 because there are 3 days. That's the cash flows from 3 days from now, right? And then you subtract your initial investment, which is your 31,000. And what I got here is a negative 1,000. So my net present value is a negative number, smaller than 0. Therefore, we should not accept the project because in order to accept the project, the net present value has to be greater than 0. When you are using a calculator, what you can do is you set up the CF0 to be the initial investment, negative 31,000. C01, that's 11,000, and there's only one cash flow for this one. And the C02 is 100, so CO2 is 1. FO2 is 1. And the CO3, the third cash flow, is 13,310, and F03 is 1. Okay, so then you press NPV and then enter the 10 for I. That's the risk required return. And then you CPT compute NPV, you get a negative $1,000. Based on this, should we accept or reject the project? And the answer is we're gonna reject the project. You could also calculate NPV. You have seen we can use the mathematical equation formula. That's the first approach. Second, we can use financial calculator. And I'm going to show you the third approach. You can calculate NPV using the spreadsheet. Okay, so this picture is showing that, okay, so my value, 0, that's the initial, that's the present, that's the initial investment, okay? And then you have value 1, that's the cash flow at the end of the year 1, value 2 at the end of year 2, value 3 at the end of year 3. And the required return is 0.1. And now let's take a look at this formula here, okay? So you enter, that's the formula for this style. So you enter NPV, okay? And then F2, what is F2? F2 is this guy. So that's this one is the rate. Okay, and then C2 to E2. So that's the C2, D2, E2, right? So we are using the required return 0.1 and also the cash flows, So after this, we calculate the net present value, and then we're gonna add B plus 2. We're gonna add this. Okay, we're gonna add this number. So my result is 1,000, negative 1,000. So you can see that when you are using 3 different approaches, you still get the same result. So the net present value for that example is negative $1,000. Okay. The payback rule. So you may wonder asking this question, how long does it take to get the initial cost back in a normal sense? Okay, I make some investment, but I'm very concerned. When can I get back the initial cost? So what we're gonna do is first you estimate the cash flow. Second, you subtract the future cash flows from the initial cost until the initial investment has been recovered. So what does this mean? I'm going to show you, okay? And then you're going to accept the project if the payback period is less than your benchmark, okay? If your benchmark is, I need to recover my initial investment in 3 years, right? And then once you go through the cash flow, you realize, well, guess what? It's going to take me 4 years to get back all my initial investment. So in that case, you will not accept it because you are setting a benchmark of 3 years. So let's take a look. So your initial investment is 31,000. And the first year, you get back 11,000. So there are still, the difference is 20,000 to recover, right? And now at the at the end of year 1, you have $20,000. And you're gonna receive 12,100. So you still have 7,900 to recover. And year 3, you start with 7,900, and then you can minus what you can the year 3 cash flow, 13,310. In this case, I get a negative number. So now I know that at the end of year 2, I haven't fully recovered my initial investment yet. So only at the end of the year 3, the company can fully recover that initial cost, okay? So if the benchmark is 2 years, you have to recover all the initial cost. Apparently, you have to reject this project. Advantage of the payback, well, it's pretty easy to understand, okay? And they adjust for the uncertainty of later cash flows. And it's based towards liquidity. What does this mean, based towards liquidity? Liquidity means how quickly you can have cash flow, right? So, so if the company is highly liquid, what happens is you're going to have lots of cash flows, right? So if you have more cash flows in the sequence of the timeline, what happens is it's going to be quicker for you to get back your initial investment. So therefore, this approach, the payback approach, they would like companies with liquidity, right? So the companies with the liquidity are more likely to be chosen, those projects to be chosen when you are using payback rules, right? This is what we call a bias toward, disadvantage payback. You can see that in the calculation, I was not taking the time value of money as a factor. So that's one of the disadvantage, did not consider the time value of money. And also it requires an arbitrary cutoff point. Let's say I want recovered in 2 years. Why? Why it has to be, having the cutoff point has to be 2 years? What about 2 years, 3 years, 4 years, 5 years, right? So this kind of cutting off point is arbitrary, right? Ignores cash flows beyond the cutoff date, right? So what happened is I set up my cutoff date, let's say a 2 years, 3 year, 4 year. If I'm not able to fully recover my initial cost during that period of time, I'm gonna drop the project, regardless how much cash flows after the cutoff point. Okay, so in this case, it's not very smart, right? Biased against the long-term project. Long-term projects often they lack of cash liquidity, so therefore, in the beginning, right, they are not getting a lot of this cash flows back, right? Because the long-term project is going to take a longer time to generate revenue, right? So let's say research and development, this R&D, right? How long does it take the pharmaceutical companies to to design and the vaccination, right? Vaccination. So it is a long-term project. That means you won't see those cash flows numbers until later times. And because this payback rule, they prefer, quicker success, right? So therefore, those long-term projects will be biased against. The average accounting return. So this one is calculated by, you calculate the average net income of the project, and then you calculate the average book value of your project. So you use the average net income divided by average book value. That's going to be your average accounting return. So this would be a ratio, right? This would be a percentage, right? So basically, you have to set up a target, right? So after this target, I'm going to take the students, take the projects. But if it's under those cutoff rates, you're gonna not like those projects. Okay. So in this example, the information given, first year is 59, second year is 650, 6,500, and the last one is 6,655. Okay, so the average income is calculating by taking the average of the three number, and the net book value is given 15,000. So then when I do this calculation, I get my average accounting return is 41.5%. So the benchmark is 25%. So therefore, mine is 41.5%. We are going to accept the project. The advantage of the average accounting return is easy to calculate. The information are already available from the financial statements. Disadvantage is that we are not considering time value of money, and the cutoff rate is just an arbitrary benchmark, right? Okay. So in this approach, they are not considering cash flows, right? You didn't see the cash flows. You see the net income. Net income is the difference from cash flows. And now let's talk about the IRR, okay, the initial rate of return. This is a very important a tool. You will see it in the exams, right? In the quiz. So the IRR is the most important alternative to NPV, net present value. Okay. The definition of this is that it is that return that makes you break even. Your net present value is zero. Okay. If your net present value is zero, you are breaking even. So in that case, what is that IRR, right? What is that required return? So that required return making the project break even, that is the IRR, okay? So you will accept the project if the IRR is greater than the required return. If you require 25%, you calculate IRR, indicating that it's a 30%, right? So of course, you're going to take that project. Okay, so how do you compute IRR? So first, just like what you did for net present value, you have to estimate the cash flows, okay? And then you are going to use tools to figure out what's the IRR. You could use financial calculator. The approach is very similar to the calculation of the net present value, okay, when you are using the cash flows. If you take a look at this picture, so the red line is the present value, okay? The red line is the present value. And when present value equals 0, that's when the red line is crossed over with the x-axis. Okay, so that is 16.13%. So this tells me that that project, okay, that the internal rate of return is 16.13%. If you want, okay, if your benchmark is 15%, you are going to accept this project. So the question I'm having here is, what is this? We know that this the cross point of the red line with the x-axis, that's the internal rate. What about here when the red line is also crossed with the y-axis at this green point, right? So, and it shows me that that value is 60,000. So this is the time when r equals 0, when r equals 0, right? This is r equals 0. What does r equals 0 mean? R equals 0 means that you are not considering time value of money. So therefore, your risk is 0, right? So in this case, the $60,000 is the sum of the undiscounted cash flows. So if you don't consider time value of money, if you okay, just add all the future cash flow together, that would be the undiscounted cash flow sum, 60,000. Okay, you can also calculate IRR with a spreadsheet. So in this picture, I have shown you that the way you set it up is like here, that's the formula, IRR, okay, and then you set up the range, right? The range is from B9 from here, right, until that'll be F9 here, right? So these are the 5 cash flows. And so you're gonna say IRR, and then we're gonna spell out a number which is 15.96%. Okay. So that's the internal, that is the internal rate of return. Just use the formula IRR and then bracket, and then you want to select, okay, the cash flows from year 0 until the last cash flow, following the order, and that formula will tell you what is the internal rate of return. The advantage of IRR is that knowing that the return is very intuitively very comfortable, right? So I know that project promise kind of like 12%. Oh, that project 13%. Okay, so that is very intuitive. It's a simple way to communicate the value of project to someone who doesn't know all the estimation details, right? For most people, they want very simple, straightforward answers to the questions, right? Sometimes people, they are not sophisticated enough. It's communication, right? It's going to be challenging. So just telling them what's your internal rate of return, that will be make it easier. If IRR is high enough, okay, you will not estimate a required return. If, let's say, your IRR is 60%, right? Well, I guess I will take that project. I don't care what is the required return. I don't care. Well, all I know is 60% is a very, very good return, right? So in general, the IRR analysis and the NPV method will normally pointing towards the same direction. The disadvantage of internal rate of return is that it does not probably help that much because NPV that will give us a decision, and IRR will just probably give the same decision in the normal situation. But there are some exceptions, okay? This would be a situation called non-conventional cash flows, okay? Non-conventional cash flows. So what happened is if you have non-conventional cash flows, that means the cash flow will change the signs more than once, right? In that case, you may have two values of internal rate of return. So later on, we're going to show you a picture, right? So that you would understand what I'm saying. Okay. And there are also some problems for this internal rate of return when it comes to comparing mutually exclusive investment, either A or B, right? That's two mutually exclusive investment. If you pick A, you can pick B. If you pick B, you cannot pick A, right? So when the situation like this, that internal rate of return can be a problem. So I'm going to show you in the next slides, in the next few slides, okay? So what is the non-conventional cash flows, right? That's when the cash flow changes sign from positive to negative, negative to positive, more than once, okay? If that's the case, there's more than one internal rate of return. So then the question is, if you get two different numbers of the internal rate of return, which number you're going to use, and how will that change your decision, right? So here's one example. It'll be more clear when we talk about these conceptual steps to get while going through this problem. So suppose investment cost $90,000 initially, and will generate the following cash flows. At the end of first year, 132,000. At the end of second year, 100,000. At the end of third year, 150,000. The required return is 15%. Question, should we accept or reject the project? So this is what happened, right? So I have the same, there are two pictures, right? So they are exactly the same cash flow structure, right? And now I'm able to calculate two numbers for internal rate of return. You can take a look. The difference between the two is in this one, in this formula, if you notice that here, that's including all these four cash flows, right? That's what they do. But this part, this second part, 0, this is the guess. The guess representing that, okay, so you estimate what that return is probably going to be, right? Okay, so I put a 0 and a returned a value 10.11%. But when I make this value, reference value, to be 0.6, okay, then they return me another value, 42.66%. So that's very interesting, right? But how does this happen, right? I'm going to explain. So this is the cash flow, right? The full cash flow. So I'm going to set up this discount rate from 0 to 0.55. So there is 0.05 increments, right? And then corresponding to each discount rate, I can easily calculate the net present value, okay? So what I'm doing is I'm going to plot this picture. You can see the red line that representing the net present value of the project. And when the red curve, okay, run across the horizontal axis, and there they leave the 2 point. The purple one is closer to 0, which is 10%, and the green one is 42.66%. Okay. So you can see this is what happened. Why they have two, right? Why they have two results. Okay, so let's do a quick summary. So in this case, if I do a net present value, so the required return is 15%, and I'm dealing with this cash flow. So my net present value is actually more than 1700, which is positive. When net present value is positive, you are going to accept that project. Okay. If you use the financial calculator, however, you will get the IRR 11.11%, right? And this one will smaller than 15%, which is the required rate. So therefore, they will reject you, right? So it's interesting why the internal rate of return can be challenged, right? Because of the math. You have to recognize that there are non-conventional cash flows, and then you have to look at the net present value, right? So when you see the cash flows, are they conventional cash flow? If they are not, you better careful, right? You better careful. And analyzing the net present value, that's the most important one. Now I'm going to talk about what we mean by the mutually exclusive project, okay? So if you have two projects, they are mutually exclusive, that means take A, give up B, or take B, give up A, right? So if you are going through the NPV analysis, you will always choose the project with a higher NPV, right? The higher the better, because that representing the value creation for the firm. If you use IRR, then that rate is higher the better, okay? But the interesting thing is here, in this example, okay, you have two projects, A and B, so they are mutually exclusive, okay? And so you have these streams of cash flows, and you calculated your IRR and net present value, right? You can do that. So interesting is, if you use NPV, your project A is $64.05, which is more than project B. So by this logic, you are going to pick net present value, right? However, if you take a look at the IRR, so the internal rate of return, actually project B is doing a better job. So that promising is the 22.17%, okay? So which you cannot take both. Which one you should accept, right? Well, okay, because these are the situation of the mutually exclusive projects. So the internal rate of return is struggled here. So let's go with the net present value. Okay, in those situations, you go with the net present value. So here, the red line, the red curve, is the project A, and the other darker color is project B. Okay. So when they run crossover, that's the time of. So when the red line run across the horizon, so these 2 points actually are the internal rate of return for the two projects. Okay. So when your curve of the net present value across the x-axis, right? Those points are the internal rate of return. Okay. The red line and this blue line, they cross over each other. At that point, net present value is equal. Okay. At that point, net present value is equal. So you want to pick the one with higher net present value, right? The one with higher net present value. So in the previous example, we see a conflict, right? If you go by NPV, you should pick a product A. But if you go with IRR, you're gonna pick up the product B, okay? If there is this conflict happen, remember you always use net present value, okay? Because internal rate of return can be unreliable when in the two situations, right? One is the non-conventional cash flows. The second is the mutually exclusive projects. Okay, so now let's talk about, let's talk about the profitability index, right? The profitability index is PI. It's actually a benefit divided by cost ratio. So what is the PI, profitability index? So that's the present value of the future cash flows divided by the initial investment. Okay. So it's net present value divided by the initial investment. So this can be useful because in some companies, sometimes they have limited capital, right? If they don't have a lot of resources, they're gonna think about how to allocate their capital, right? So basically, the profitability index communicate directly, okay? What is the value creation? Okay, what is the value creation? So when the capital is scarce, you want to allocate your resources, the capital, to those projects with the highest project PI, profitability index. Okay. The advantage of profitability index is that often it leads to the same conclusion with net present value. It is easy to understand and communicate. Okay. The disadvantage is, again, it happens when you have mutually exclusive investment. Okay. The practice of capital budgeting. So basically, net present value and IRR are the most commonly used primary investment criteria. The payback is also commonly used, but is considered as a secondary investment criteria. Okay. Capital budgeting techniques are different with each industry. Okay. Last, we are going to quickly talk about what's the capital rationing. The capital rationing occurred when a company or division have profitable investment, that is to say a positive net present value, but they cannot get the needed money to undertake them. They cannot get the ball rolling because they know the project, everything makes sense, but the initial investment is too high. I cannot afford it. So here are some of the terms, vocabularies, self-rationing. So that's the situation. The limited resources are only temporary. Okay. Hard rationing means that the company is suffering financial distress, right? So it's not a short-term thing. Okay, so that's it for today. All the best and have a good reading week.